right now we're joined on the phone by Joe Saluzzi, head of equity trading at Themis Trading, and he said that the flash crash shows there have been, quote, huge unintended consequences because of high-speed trading. Joe, I know that you've been pretty active on this particular issue, and I know that this is a dense report. It's a long report. It looks like, though, the initial finding here is that it was a trade of E-minis, 75,000 E-minis worth about $4.1 billion. I'm just curious what your initial reaction, and again, with the understanding that you have not read the full report.
Well, initially, it appears they are blaming a particular specific instance. We still would argue that there's a structural problem in the equity markets. This may have been obviously exacerbating a problem. We had a big day that day. We were down 400 points as is, so no doubt there could have been a spark on it. But we still think a market like the United States equity market should be able to handle futures-related selling. And since the May 6th flash crash, we've had many mini flash crashes. We had one this morning in the LQD ETF, which went down over 12 points within 2 seconds, okay? So there are more issues here. We can't just blame a rogue algorithm. It's just too neat and convenient. So, like you said, we haven't read the whole report yet. We've got to dig into it still. But to blame one algorithm and one particular futures contract, I'm not really sure if we agree with that.
Joe, could I ask, because we were just interviewing Dick Beauvais within the last couple of moments, and he was saying that when you have stories like this, when you have the flash crash, and saying that perhaps it was one algorithm that actually started this precipitous decline, that it does tend to shake confidence of investors. What do investors need to know or need to hear to be assured that safeguards will be in place so this won't happen again? Right.
They need to see some structural changes. Exactly. You're exactly right, Mark. This could happen, tomorrow, any day, anytime there's an issue in Europe or something like that. Things happen quickly. We all know that. So we need structural changes to the market. We were expecting them to, talk about stub quotes and talk about the elimination, enhancing the single stock circuit breakers, doing some kind of Band-Aid work, but then we're actually looking more as to why there is no real liquidity in the market. What happened to the real market makers? What happened to the capital providers? They've all left, okay? So we're talking about now what has changed in the equity market. Then you need bigger term fixes, like do we really need all these cancellations coming through? Over 90% of the orders are canceled. Do we need this thing called a maker-taker model where people are encouraged to add liquidity only for a fleeting moment so they can capture a rebate? There are all sorts of things that need to be addressed. Do we need a fragmented market like we have now with over 10 exchanges and 40 dark pools that continue to just route things back and forth to each other? You can bet that had a big part of this crash.
All right, Joe, thank you very much for joining us with some quick reaction there to, again, this report that's just been released by the SEC and the CFTC saying that the May 6th stock market crash was triggered in part by just one algorithmic trade. Joe, thanks a lot.